Ladies and gentlemen, welcome back to another episode of Boss Economics World, your go-to channel for brutally honest, sharp-edged satire on all the economic blunders brought to you by the government. Today, we're zeroing in on the UK's seemingly never-ending housing crisis, the perfect storm of sky-high interest rates, crippling taxes, and a government that seems more interested in playing fiscal roulette than genuinely fixing the economy. We've got a lot to cover, so let's break it all down and expose the real economic rot that's going on behind the glossy political speeches. Hamptons International has downgraded its prediction for UK house price growth in 2026 from 5% to a measly 3.5%. Why this shift? Well, buckle up, it's a cocktail of rising borrowing costs and a lackluster economy that might just be the final nail in the coffin for many homeowners and prospective buyers. As one of the UK's most prominent housing markets continues its slump, the real tragedy isn't just about falling house prices, it's about the stagnation of the once booming housing sector, which could now face a slow, torturous decline. Taking a deep breath here, have you ever seen a government so out of touch with not just its own economic forecast, but the people it's supposed to govern? Nothing short of reckless. Interest rates in the UK remain stubbornly high. Even though the Bank of England cut its benchmark rate for the second time this year, high interest rates are not fading away anytime soon because of the government's unrestrained fiscal policies. Wait, didn't they say cutting rates was supposed to ease the pain for all of us, especially for mortgage holders? Yeah, well, apparently the fine print is, we'll ease your pain, once we're done squeezing you dry first. The inflation monster created by years of irresponsible spending continues to loom, chewing away at household savings and purchasing power while keeping mortgage rates sky high. It's not just homeowners paying the price, it's renters too. With rates this high, homebuyers are retreating in droves, flooding the rental markets, which is pushing up rents even faster than inflation in key urban centres like London. The more the government stays clueless, the more ordinary people suffer. If the housing market were a patient struggling to catch its breath, Labour's new fiscal policies might just be the heavy hand pressing down on its windpipe. In their latest budget, Labour has made it clear they're not here to play nice. They're ramping up national insurance contributions, yes, squeezing businesses harder, hiking stamp duties on second homes, and increasing taxes left, right, and centre. This is essentially putting the squeeze on employers and individual property investors, which directly dampens consumer demand and employment, a toxic recipe for economic contraction. Let's talk about the increased stamp duty on second homes. Why would this matter? Well, property investment isn't just for stockbrokers and hedge fund managers. Millions of Brits have second properties, either as long-term investments or rental properties, which in turn supports the private rental sector. Labour's tax hike is an open assault on these middle-class investors, discouraging them from buying, renovating, or even maintaining second homes. This will crush housing supply in the rental sector and indirectly drive rental prices even further up, worsening affordability for struggling renters. Now, Labour's tax rises aren't just for property investors or the wealthy, these hikes are hitting businesses and working-class households across the spectrum. A data point worth noting, the UK is now facing its largest tax burden in over 31 years. That's 3 decades of burden accumulation being dumped squarely on today's consumers and workers. What this essentially means is that inflation-adjusted take-home pay is being squeezed tighter than ever, and companies, taxed out of their skins, are likely to slow wage increases or hiring altogether. Great job, isn't it? What happens when wages stagnate and inflation still runs hot? Your real income plummets, so it's no surprise that real income growth has ground to a near halt. Companies tightening their belts means layoffs, hiring freezes, and retrenchment schemes. Given this scenario, households are tightening the reins on spending, which in turn contributes to the ongoing weakness of demand across the broader economy. It's all connected: fiscal policies, taxes, real wages, consumption. And it doesn't take a Nobel-winning economist to see that when you hike taxes and worsen business conditions amidst an already sluggish economy, you're weaponizing recessionary pressure against your own people. The latest data from Nationwide Building Society shows that UK house prices barely grew in October. Buyers are running for the hills as Labour's fiscal policies threaten to keep borrowing costs elevated. London, one of the city's earlier shining stars of home price appreciation, has now suffered its biggest month-on-month fall in buyer demand. Yes, depressed consumer confidence is the new normal, and frankly, the trend doesn't look like it'll reverse anytime soon with such fiscal mismanagement in place. The truth is, homebuyers are eyeing their mortgage rates with equal helplessness as they do the government's policy disasters. When mortgage rates hover at jaw-droppingly high levels, anticipation of rising taxes kills appetite for property. Would you put down £400,000 on a house while seeing red flags across the country's economic policy landscape? While some analysts, optimists, really, over at Hamptons International project house prices might still rise by 3% in 2025 and continue to grow at around 3.5% in 2026, here's the big caveat: this is largely based on the assumption that inflation and fiscal policies stabilize. However, even these tepid growth numbers are significantly lower than prior historical cycle peaks, suggesting that the UK's housing market might be growing, but by definition, it's limping forward at a fraction of its former performance. Consider the unloaded burden on prime properties in London's upper tier. You've got areas where tax drag in the form of higher national insurance and stamp duty will slow transactions and erode wealth accumulation. These sectors, often those that drive inflows of capital and investment, are set for choppier waters. Add in Labour's new waves of taxation and you're essentially telling the sector, shift gear, expect mediocrity. However, interest rates aren't the only problem. Yes, inflation is decelerating compared to the runaway double digits we witnessed last year, but it's far from under control. Energy costs have ticked down, but core inflation, encompassing food prices and services, remains persistently high. Food inflation recently hit an astonishing 9.3%, which doesn't inspire confidence that the government has much command over the situation. These price surges attack the core of consumer spending, eroding disposable income and eating into savings. Is this the reward for the government's so-called prudent management? Now, couple this with the fact that energy bills have begun creeping back up, and you've got an inflationary environment that's beyond sticky, it's concretely embedded into ordinary household life. All these slippages add up to one reality: the longer inflation smolders, the higher the chances that we aren't seeing much relief on interest rates anytime soon. Also note Hamptons' projections that the UK base rate could reach a new norm of around 3.5% by 2026. Look, they can talk about normalcy all they want, but the fact remains that any base rate above 3% with current wage stagnation and affordability challenges would be disastrous for the property market. What's worse is any hope of significantly cheaper mortgage rates fades in the face of stubborn inflation. That the new norm is more of a fantasy than a viable solution unless there's a seismic shift in broader economic policy. So, my dear viewers, what we have right now is a fragile economy weighed down by staggering borrowing costs, punitive taxation policies, and contradictory governmental actions that are shaping up to hinder any major recovery in the housing market. The real issue here isn't just weakening house price growth, it's the toxic feedback loop between flawed fiscal strategy, inflation mismanagement, and a housing forecast hampered by structural inefficiencies. The reality check within Labour's latest budget announcement should have been the moment to stabilize the ship, but rather, they've set a course straight into economic stagnation. It's time the government wake up to the fact: you can't flog a dead horse, and right now, the UK housing market is gasping for air. Unless we see meaningful reform, particularly a rollback in tax hikes and better handling of monetary policy, we're not just looking at a stagnant market, but the potential for an outright collapse in investor confidence. And believe me, when the housing market falls, it takes the rest of the economy with it. Well folks, now's the time for you to ask yourselves, how long can a market sustain this level of dysfunction? With wages stagnating, inflation uncontrolled, and taxes rising like the tide, the question we should be asking is, how much economic pain is too much before both the housing market and broader UK economy risk a double-dip recession? For now, keep your eyes open, wallets closed tight, and stay tuned to this channel.